Hi everyone, so today I'm with Dom and we are going to be doing an earnings update for JP Morgan for Q1 of 2026. Dom, whenever you're ready.
All right, can you see my screen?
Yeah, perfect.
Wonderful. All right, so JP Morgan actually did really good this past quarter. The article kind of doesn't really waste any time, so we'll just jump right into it. So earnings, they're at $5.94 per share versus $5.45, which was the original estimate, so beat on that. Good.
Nice.
Revenues at 50.54 billion, which is better than the estimate, which is at 49.17 billion. So again, nice beat there. They state the company said net income rose 13% to 16.49 billion, or $5.94 a share, which is what we just saw. And then, as we just saw before, revenue increased 10% to 50.54 billion. The bank's fixed income trading revenue rose 21% to 7.08 billion, or about 370 million more than the street account estimate, on rising activity in commodities, credit, currencies, and emerging markets. They said that investment banking fees jumped 28% to $2.88 billion, or 260 million more than expected, on higher mergers advisory and stock underwriting fees. Another factor they
Wow.
say that helped with the bank top expectations in the quarter, it set aside less money for loan losses than analysts had anticipated, which is kind of interesting to see. And then they say the firm's provision for credit losses was at 2.5 billion, about $500 million less than street accounts estimate, and it's a sign that J.P. Morgan's borrowers remain healthy. Specifically, the firm released reserves for the consumers by 139 million in the quarter, through business reserves were boosted by 370 million. A year ago, the firm's provision was at 3.3 billion. So as we can see, they're doing pretty well for themselves. Nothing too worrisome from the past quarter. But they do kind of give a little word of caution. In this next section, it talks about, quote, complex set of risks. So I'll kind of jump a couple paragraphs into more important stuff. It says right here that this year markets have been roiled by concerns over disruption from the latest artificial intelligence models, the risk posed by private credit, and the Iran war that began in late February. JP Morgan CEO Jamie Dimon said in a statement Tuesday that the U.S. economy was resilient in the first period thanks to consumers and businesses spending and repaying debts, but he noted that uncertainties were mounting, and this is where it gets good. He says, quote, there is an increasingly complex set of risks such as geopolitical tensions and wars, energy price volatility, trade uncertainty, large global fiscal deficits, and elevated asset prices. He says, while we cannot predict how these risks and uncertainties will ultimately play out, they are significant and they reinforce why we prepare the firm for a wide range of environments. Um, and then one last thing to note, he says that the guidance was lowered for 2026, for full year 2026, net income, a key driver of bank earnings from the previous 104.5 billion to 103 billion. So there is just some stuff they're still trying to mitigate loss-wise for the near future, like they mentioned. Definitely uncertainties with the war in Iran. Obviously, the mounting oil prices currently from the straits being blockaded and things like that. Just a little bit of uncertainty, kind of with different things, like I mentioned, that kind of keeps them a little more conservative. But overall, quarter for them was very good. Like I mentioned, beat on earnings, beat on revenue, doing pretty well. Can't really complain too much. So we'll switch it over to Matt and we'll kind of take a better look at their financials and see how they're doing.
Okay, thank you, Dom. Appreciate it.
Yeah.
All right, so first we're going to take a look at where their 52-week low and 52-week high are, where the stock is trading at. So right now they're trading at 309.95. We have that their 52-week low is 226. Their 52-week high is 337.25. So they're certainly at the higher end. I would definitely wait for a sell-off. We're going to get to Tipranks, what they're going to say, but essentially they're going to agree with me more or less so. But the next thing we're going to take a look at is Simply Wall Street. Now, Simply Wall Street is going to say that right now the free cash flow is negative. Don't panic. I had to look this up as well with Dom in ChatGPT. It's because of inflows and outflows and loans. It's just how different banks are structured rather than your more traditional companies that we've covered, like a McDonald's or an Apple or something like that. It's just a little bit different. So don't be too panicked about that number there. Now, when we take a look at the financial health, again, the financial health, you're going to see elevated debt. Again, they're a bank, they loan out money. So they're going to have elevated, they're just going to have a lot of debt. So again, don't worry about that either. Okay, so with that being said, we need to see if they're over or undervalued in the DCF. And right now we're going to see that it's undervalued by 28%. That was Wall Street forecast. In historical growth, which, like Dom was saying, net income grew, I think, 12% or 11% or 11 to 13%. And with that estimate in mind, it's 48% undervalued. So it is undervalued based on DCF. It does look pretty reasonably attractive, actually, I would say in general. When we take a look at the net income also looks very good. We have 37.6 billion in 2022. Now it's 58.8 billion. Again, that's really good for a bank. It's still growing. So nothing to complain about there. And lastly, Tipranks, like I was mentioning before, it's a moderate buy, 9 buy, 7 hold, 16 rating. You have to be careful. It's only 8% upside with it. I do agree that it's not the best time. I like the company, obviously, but it's trading at 309. A low is 288, and the average is 335. There's not too much upside on it currently. So I'd certainly wait for a bit more of a sell-off, probably like another 10 to 15% sell-off to get into the company. Dom, is there anything else you wanted to add? Any comments?
Um, Nothing really to add. Just reiterating, yeah, like there's not too much upward mobility with this one right now.
Yeah.
So definitely waiting for a price dip would probably be the best option at this time.
Yeah, totally agree. All right, Dom, thank you. Thank you, everyone.
Thank you.